Hey everyone, and welcome to The Explainer. For the longest time, investing has felt like this super exclusive club, right? Just a daunting task filled with endless options, confusing charts, the whole shebang. But what if I told you that in 2026, making investing easy and totally accessible is actually possible for everyone? Today, we are completely demystifying wealth building. We're going to break it down into just 3 incredibly simple steps. So no more excuses, let's get right into it.
Let's be totally honest with ourselves for a second. Are you paralyzed by the fear of investing? Be real. If the answer is yes, you are completely normal. For most people, the absolute biggest hurdle is literally just getting started. The financial world is packed with so much complex jargon and conflicting advice, it is incredibly easy to feel totally overwhelmed by the unknown. You might be terrified of making a mistake, picking the wrong stock, and losing your hard-earned cash. And that fear, it can be so paralyzing that it causes people to put off investing altogether.
But here's the thing. Avoiding it is actually the only real mistake you can make. It is time to take control of your financial future. And the secret? It isn't about becoming a financial genius overnight. Not at all. It's simply about breaking the process down into manageable pieces. Because when you do that, you empower yourself to start building wealth with total confidence. It really doesn't have to be complicated, and I promise, by the end of our time together today, you're going to have the exact tools you need to finally take action.
Okay, let's dive into this. Meet Sarah, starting small. Now, Sarah is 25, and she's going to be our proxy today. She is definitely not a Wall Street expert, she does not read complex financial reports for fun, and she absolutely does not have a secret trust fund. She's just an everyday person who knows she needs to start building her wealth, but feels, frankly, a little intimidated by where to begin. Sound familiar?
$500. That's it. Sarah does not have a massive fortune to pick off her journey. She is starting with a very accessible $500 a month. See, there's this huge misconception out there that you need thousands and thousands of dollars just to open the door. You really don't. It's not about having a mountain of cash to invest up front. It is entirely about starting small and, much more importantly, staying disciplined.
Step 1. Automate your savings. This is the very first tool in Sarah's journey. And honestly, you can think of it like a powerful shield. When you rely on emotional, manual investing, actually logging in, staring at those scary red and green lines, and manually deciding to move your money, your brain kind of becomes your worst enemy. You might forget to transfer the money, or you get nervous and decide to just wait and see. Emotionless, automated investing takes that paralyzing fear completely out of the equation. It acts as a shield against your own hesitation. It ensures you're consistently setting aside money for your future without even having to think about it.
So, practically speaking, how does Sarah actually pull this off? Well, it can be as simple as setting up a direct deposit right into a brokerage account. You basically treat it exactly like a recurring bill, except you're paying your future self first. Alternatively, she can use a modern robo-advisor. With the massive rise of robo-advisors today, they literally do all the heavy lifting for you. It genuinely makes getting started easier and more accessible than at any point in history.
Step 2. Diversify your portfolio. Now, if automation is our shield, diversification is our sword. And what Sarah uses to diversify are low-cost index funds, or ETFs, which stands for exchange-traded funds. Now, what does that actually mean? They are simply investments that spread your money across a massive range of assets all at once. So instead of buying a tiny piece of one single company and just praying they do well, you are buying a tiny slice of hundreds or even thousands of top companies simultaneously. If one company struggles, well, the others are right there to balance it out. This dramatically reduces your risk while keeping your long-term growth potential very, very healthy. But wait, why low cost? Well, here is a golden rule for you. Avoid the high fees of actively managed funds. These funds involve paying an expensive human to try and beat the market, and frankly, they rarely ever do. Bypassing those massive fees means you are keeping exponentially more money in your own pocket over time, and that creates significantly more opportunities for your wealth to actually grow. And that brings us to step 3. Patience and compounding. Listen, investing is a long-term game. Once Sarah automates her $500 a month in her diversified funds, her main job is literally just to wait. At age 25, she starts. By age 30, she stayed consistent, and the absolute magic of compound interest kicks in. Fun fact for you, Albert Einstein supposedly called compound interest the 8th wonder of the world. And it makes sense. Your money earns money, and then those earnings start earning more money. By age 35, simply because she let the math do the heavy lifting for a full decade, she has accumulated a very substantial nest egg. Of course, we have to be realistic here. The journey won't be a perfectly straight line upwards. You are going to have to ride out the ups and downs. There will be scary news headlines, and there will be market corrections. That's a given. The absolute key here is avoiding short-term panic.
If you get scared and pull your money out when the market dips, you guarantee a loss. Stay consistent, ride the waves, and keep your eyes fixed firmly on the horizon.
So the crucial point is your simple investing blueprint. To quickly recap this incredibly simple yet wildly effective blueprint. Step 1. Automate your savings to take the emotion right out of it. Step 2. Diversify with low-cost index funds to reduce your risk. And Step 3. Stay consistent and let compounding do the heavy lifting. That is literally it. This boring consistency is exactly what builds incredible wealth. You absolutely do not need to be some Wall Street hotshot to succeed. You just need to ignore the noise and stick to the plan. As we wrap up this explainer, I have a big question for you. What is your biggest investing fear? Seriously, now that you know the 3 steps, what is the one hurdle that is still standing in your way? Share your thoughts down in the comments. We are building a really great community of investors here who are taking control of their futures, and we are right here to support you. Start small, stay disciplined, and I will catch you in the next explainer.